All right, so let's take a look at reporting liabilities and stockholders' equity. So our liabilities, we know that we have current liabilities we show, they're due within a year. Long-term liabilities due beyond a year. Stockholders' equity, it is on our balance sheet. And then we have our separate statement, the changes in stockholders' equity. So remember, we have our balance sheet, our income statement, our statement of cash flows, and our retained earnings statement. While our changes in stockholders' equity are disclosed separately. So here's an example of a balance sheet. So we show our liabilities. We have our current liabilities, our long-term liabilities, which includes a bond payable, and we have our total liabilities. Stockholders' equity, we have our paid in capital section. So we have our preferred stock, our common stock, and then our additional paid in capital in excess of par. So our total paid in capital, $3,520,000, plus our retained earnings gets us a total stockholders' equity of $8,100,000. And then we have to reduce treasury stock from stockholders' equity. Remember, treasury stock is stock that we issued before and we bought back. So we take the $8,100,500 less $75,000. We get total stockholders' equity of $8,025,500, and the total liabilities and stockholders' equity of $9,802,050. So here we have a separate statement that we show with our financial statements called a statement of stockholders' equity. So this shows the changes in stockholders' equity. So we have our five categories on the top: preferred stock, common stock, paid in capital, retained earnings, and treasury stock. We show our beginning balances, and you see net income we add to retained earnings. Dividends, we reduce it from retained earnings for $250,000 and $400,000. Issuance of additional common stock, $500,000 that we added to common stock, and then we had $50,000 that's paid in capital of excess of par. And then finally we bought some treasury stock, so we show a negative under the treasury stock bucket because that reduces stockholders' equity. We get our ending balances, we add them up, and our ending stockholders' equity, $2,220,000. So let's look at the financial share. Earnings per share is a pretty important thing that financial analysts look at. So it's a big profitability measure shown in the financial statements. The financial press is all over it. So if you open up a Wall Street Journal, you will see earnings per share mentioned quite a bit when you go read about the stock market. So earnings per share, to calculate it, we take our net income from our income statement, less preferred dividends, divided by number of common shares outstanding. So here's an effect, taking a look at the effects of 3 different plans that we can do to finance our operation, and its effect on earnings per share, which is an important measure. So companies like to show earnings per share high because it's an important measure. So when financial analysts look at your stock and the market dictates the price on what your stock sells for, earnings per share is pretty big. If your earnings per share is high, then your stock's going to sell for more. So companies do have incentive to make that number go a little bit higher. So plan 1, we can just issue $10 par value common stock. That's all we're going to do. So we show our earnings per share at the end comes out to 60 cents. Plan 2, 50% preferred stock, 50% common stock. See on the bottom, our earnings per share comes out to 80 cents. Plan 3, we can issue 6% bonds, which is 50% of what we're doing. We get 25% from preferred stock and 25% from common stock. And you see our earnings per share on that one is $1.28. The key here is that usually companies use all 3 methods. You use bonds, you use preferred stock, you use common stock Typically, your big companies have all of these. And that's the end of chapter